afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. For our new listeners, before I introduce today's presenter, a few quick notes. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we welcome back our good friend, Charlie Chesbrough, Senior Economist at Cox Automotive. Charlie, we last had you on in December, and a lot has happened since then. So I'm just going to let you take it away.
All right. Well, thank you, Rachel, and thank you to everybody for joining us today. And a lot has been going on, and I'm going to try and take everybody through what we're seeing out there. We're going to start by talking about the U.S. economy and the nice comeback that we've had so far, and what the outlook is for the remainder of this year. Then I want to talk a little bit about some of the viewpoints that we're seeing out there from market participants. We've got some survey research that I thought it was worthwhile to share with you, and what people are feeling about their mood right now, if you will. And then I want to get into a deep dive into what we're seeing in the new and used markets, and some of the changes that we're seeing post-COVID that I think are probably going to be essentially new normals that we're going to have to deal with in the vehicle market. Maybe not forever, but I think certainly through most of 2021, these are going to be issues. So let's start by talking about the economy. This is a chart that's showing economic growth quarterly going back since the beginning of 2000. And you can really see, I think this really just demonstrates the magnitude of what we've been through here in the U.S. economy in 2020. You can see that we had the first quarter of last year, and highlighted in red on the far right side here, we fell 5%. Then the economy fell 31% during the Q2 of last year, before having a nice comeback in Q3 and then getting more back to normal in Q4. But you can see I've highlighted in red the downturn that we had during the Great Recession back in 2008, 2009. And you can see it pales in comparison in terms of the magnitude of what we've been going through. So I just think it's important to keep in mind that when people talk like COVID is unprecedented territory, I think you can see from this chart alone as to why that's the case. The outlook for this year, though, is that economic growth is going to be very, very strong. I've seen forecasts everywhere from 5% economic growth to 7% economic growth for the year. So I think without a doubt, we're going to see the U.S. economy start to be in much better territory throughout the course of this year and heading into next year. But that's not to say that there's not headwinds, and certainly for the vehicle market, there remains a number of headwinds, and I'm going to talk about those. We also look at the Business Recovery Index. This is put out by Moody's and CNN, just to kind of give a broad measure of where is the economy at. And what you can see from the chart here is the most recent data point puts us at 78.11, with 100 sort of being normal. We're essentially running about 80% of normal right now in the U.S. economy. Everything's just down a little bit, and we've essentially flatlined here. You can see we had the comeback last spring, but we really haven't seen much change in the overall economy, at least through this metric, over the last 6 or 7 months. And you can see that regionally around the country, some states are back much better. Those states are highlighted in yellow. You can see South Dakota and Florida appear to be leading the way. And then some states still have a long way yet to recover, like you can see in the state of New York or New Mexico or Illinois. Those states are darker red. So on the whole, the economy's back about 80%, but we can see there's various parts of the country that still remain in a much more precarious situation. And different parts of the economy are suffering differently. I've got two different charts here. One's more automotive focused on the left, and on the right is sort of a broader measure of different sectors of the economy. And let's start with the right, looking at consumer spending for different sectors. And we can see that looking year over year, where consumers spending their money, we can see that sporting goods and toy stores and discount stores, hardware stores, that consumer spending in these sectors of the economy is actually up on a year over year basis. But if we look at the bottom of this chart, we can see that transportation and travel related sectors still remain quite suppressed. Our expectation is that we're not going to see travel making any kind of a significant comeback until we get the vaccine distributed and folks take this vaccine and we get back to a situation where the fears about the virus are much lower than they are today. We're not quite there yet, but our expectation is in the second half of this year, we should start to see travel start to make some significant gains. On the left side, these are more automotive focused sectors of the economy. And you can see in blue, that's vehicle sales. And they're doing even better than the overall economy, which is there in gray. But one of the interesting things that you can see there is the green line, that gas stations have really started to take off just in the last few months. And it does appear that folks are starting to travel again. We'd seen that vehicle miles traveled had declined. The people were not driving their vehicles as much. But we can see from that green line that it does appear that spending at gas stations is now starting to get back to more normal. The other one that's kind of interesting is the red line, which is ride hailing, your Uber and Lyfts out there. We saw that during the pandemic, it fell substantially and stayed very, very low. But again, over the last few months, it's starting to make a recovery, again, suggesting that people are starting to get back to work and they're starting to feel a little bit more comfortable about using shared transportation. But the important thing that we like to track is the unemployment rate and what does it mean for the overall economy. And I'm showing here on this slide really the entire history of the modern US economy's unemployment rate. Again, just to give you some perspective as to what we've been going through. And you can see that on the far right, that the massive jump that we had in the unemployment rate last spring when the pandemic hit, we approached almost 25% unemployment, but it's been quickly subsiding since then. The most recent data points are a little bit volatile. We saw in December that we lost 300 jobs. January was essentially flat. Then we saw in February we had a nice gain. Overall, the unemployment rate, the U3, which is the key measure, which is headline unemployment, is down to 6.2%. If you look at the broader measure, which is underemployment, it is substantially higher, but it's also heading in the right direction. So the unemployment situation, it's still precarious. We still have folks that are losing jobs out there, but the worst of it is definitely behind us. And we expect that we're going to start to see these employment numbers really improve in coming months as we start to see more and more states open, more and more service sector jobs return. Certainly the restaurant industry in particular is going to have a substantial impact on these unemployment numbers here in the next couple of months. But one of the reasons that folks are so optimistic looking forward, and particularly into the second half of this year, is this idea that there's a tremendous amount of pent-up cash that consumers are sitting on. And this is from the Federal Reserve that actually tracks accumulated pandemic deposits. We've seen the savings rate has really exploded during this pandemic, that if you have not lost your job and you've been able to keep your job, you've actually been doing quite well in this environment. You haven't been spending very much. If you're at the lower end of the income, you've been getting checks from the government, and a lot of folks have just been putting that savings into the bank. And at this point, we have over $3 trillion of accumulated savings in February, that at some point, this is going to get unleashed onto the economy. As people start to feel comfortable about COVID, start to feel a little bit more confident about the economy and their circumstances. And this is why a lot of folks are really optimistic that this money is going to spur a lot of economic activity in the second half of this year and help us get to that 5, 6, or 7% economic growth. So this is kind of on the back burner, but there is concern that that could be inflationary, and all of that spending could have inflationary effects on the economy. And we are starting to see some early signs of inflation, although I have to admit that there's really not a lot out there just yet to be worried about. But I do think it's important to kind of keep it on your back burner, because with all the spending that we've had going on, one would think that inflation might be around the corner. Now, when we think back about inflation in the 1970s, there was really two main contributors to inflation. One was rising labor costs or wage rates, and then, of course, energy prices and oil prices. We don't really have either of those two situations going on right now, at least in anything similar to what we had in the 1970s. We do know that when it comes to wages, that wages have been rising. We know that a lot of states around the country have been implementing their own minimum wages, not quite $15, although some states are at $15, other states I think are at $11.25. It varies a little bit, but there are a number of places where wages are starting to rise because of these set minimums by state governments. We also have a situation where oil prices, which had been very, very low, consumers have been enjoying very, very cheap gasoline. Well, it's now starting to make the move. As we get into summer, we always know that gasoline prices tend to rise in the summer, but we also know that gasoline prices are up substantially from where they were in the depths of the crisis. And in the blue line, you can see here that we were below $2 a gallon about last March or so, when the worst of the crisis was happening. But we've now risen significantly from then, and we're getting back towards a more $3 a gallon level nationally. Now, I will say I don't think oil prices have quite the impact on the U.S. economy as they used to have. We are now an energy exporter, so when oil prices go up, the U.S. on the whole probably benefits because we produce a lot of our own energy now. But it does hit consumer spending, and it goes directly at people's disposable incomes, and certainly their consumer confidence is hit when we have much higher energy prices. We're not there yet, but again, it's just one of those things to keep an eye on here that could be a signal of upcoming inflation. And I'll show you some things that we're seeing in the vehicle market that might be a little bit more worrisome about inflation. The other thing I wanted to walk you guys through is what we're seeing regarding people's opinions about what's going on in the marketplace today. And one that we look at very closely is consumer sentiment. And this is from Morning Consult. They survey thousands of people every day to gauge what is their overall view of the U.S. economy, how confident are they about the U.S. economy. And we can see this is going back through January of 2020, that we fell off a cliff when the virus hit us in the middle of March of last year. And we've now been making a very slow, sporadic recovery, but we have made an improvement, going from about 81 up to about 93 over the last 11 months or so. Still far below where we were before. We're still down about 18%, and that weakness in consumer sentiment is a real detriment to vehicle buying. We know that confident consumers are the folks that are willing to go out and buy a new vehicle, borrow $30,000 or more to get that vehicle. So you need confident people that are secure about their own situation as well as the overall economy. And you can see we're not there just yet. But this line's actually, I think, a little bit misleading because it looks like over the last few months it's been slowly improving, but on the whole, nothing too earth-shattering. But this is the average. This is across all of America. And within it, you have optimists and pessimists, you have rich people and poor people, and you have Republicans and Democrats. And I know I've talked about this before with this crew, but I just wanted to share this slide with you. The University of Michigan is able to track consumer confidence by your political party affiliation. And one of the interesting things is from the line I showed you on the previous page, that purple line is essentially the same purple line here. And the makeup of what is consumer sentiment has changed dramatically in this country over the last year. And in one way, it's changed is by looking at the political party affiliation. A year ago in February, Republicans had consumer sentiment 47 points higher than Democrats. And yet just last month, the numbers had almost completely reversed. And now Republicans are 26 points below Democrats in terms of their political sentiment. And Democrats are much more optimistic. So overall, the purple line doesn't look changed too much, but the components within it have changed drastically. And I really just point this out so that you can keep in mind that who may be coming in to shop in your dealerships this spring may be a little bit different because of how sentiment is changing out there, depending on what people's political affiliation is. The other survey that we also do is talking to dealers out there, and we do a quarterly survey at Cox Automotive where we ask the dealer sentiment and what is their view of their business and the overall operating environment. And the main question we ask is how would you describe the current market for vehicles where you operate? And you can see the most recent data point on the far right is essentially unchanged from where we were in the fourth quarter. And that seems to be a fairly reasonable position to be in. Folks had pulled back a little bit in terms of their level of optimism after we had the nice rebound in the third quarter. Again, I think a fairly reasonable position to be in. And at this point, it looks like folks feel fairly confident about the situation in their own market, and they're not expecting any substantial changes at this point in terms of their current market. But they are optimistic. And when you ask them, what do they see the market to look like 3 months from now? All of the dealers expect that the market to be much stronger. And again, I think based on some of the numbers I'm showing you from the economy, I think that's a fairly safe assumption to think that the market is going to be strong. We do expect demand to be particularly robust. And even later this month, when people start receiving these checks, it's going to mean a lot of money in people's pockets. $1,400 for individuals, up to $5,600 for a family of 4. And I can tell you that almost everybody that could potentially be a used car customer is going to get that money. When you look at the new vehicle market, they generally have a much higher income, and the stimulus kind of phases out once you get over $100,000 of income for a couple. So it's very possible that a large swath of the normal new car customer market isn't going to be getting these checks. But in the used car market, those natural customers are going to be getting those checks, and so it could be a very, very strong spring season in terms of demand, particularly in the used car market. And we asked dealers, what are some of the issues that are holding back your business? Some of the ones that kind of jumped out that I find interesting are, of course, the business impacts from COVID still remains number one. And the other one that's number two is limited inventory. And I'm going to talk a bit more about that, but that's going to continue to be an issue for the industry through this year. But we also see expenses has started to make a significant increase. And I think that can be attributed to the cost of acquiring inventory, as well as just overall cost of paying people in the market today. Just costs in general continue to rise. And of course, weather was a big issue this last quarter. We had the big Texas freeze, and that certainly had an implication for large parts of the market. 1 out of 11 vehicles sold is in Texas. So that the weather that we had last month certainly had an impact on the marketplace. And the last one here, regulations. We see that that's starting to make a little bit of a move, still on the low side, but I think there is some concern out there that some of the new lending requirements may be a little bit tougher coming from the new administration. It may be a little bit more difficult to get credit approval for some of the lower subprime type folks. So we may see more financial regulation coming, and I think folks are a little bit worried about that. And as I said before, just real quick, the top priorities that we asked dealers about that they said that they're addressing right now, finding and buying inventory was the main priority for everybody last quarter and continues to be so for this quarter. And that's going to be a challenge, I think, going forward. The market right now, and again, I'll talk more about inventory in a minute, but it still remains lean out there. And I think that we're going to find getting inventory is going to be a real challenge, and you're going to have to pay a lot more for this inventory than what you had been used to, because we have seen that valuations have made significant gains. The other one I just think is kind of important here is retaining customers is much more important for franchise dealers than it is for independent dealers out there. And I think this year in particular, it's going to be very, very important. We saw a lot of market share changes in the new vehicle market last year, and a lot of it was just out of control of the manufacturers. States were shutting down, the virus was breaking out all over the country, governors were shutting down operations, opening up business. And so there was a lot of moving parts. So I don't think that market shares are particularly stable from last year, that if you lost ground last year, it's very possible to regain. If you gained ground last year, it's very possible you can lose it this year. So I think that's going to be a very competitive marketplace out there, as it always is, but maybe this year in particular. And the other one we look at is what are consumers saying that are shopping on our websites. And we do a survey. Kelley Blue Book does a consumer impact study where they're surveying customers to ask them what is their view of the marketplace and what are their purchase intentions over the next 6 months. And we've been asking this question really over the last year, ever since the virus broke out. And you can see it's been a little bit volatile. We started with about 20% of consumers saying that they were going to delay a vehicle when the outbreaks first happened. And then you can see that it went down quite a bit, that once we had the recovery period, that people were not that concerned, that they weren't going to hold back from the market. Then it started to creep back up again, last Thanksgiving time. And then it's again reached a peak there in early February, I think, with a lot of concerns whether the package was going to pass, the turmoil that we saw in the Capitol in January, and it's now starting to tick down. But, it does seem like we're sort of hovering in this 1 in 6, 1 in 5 folks thinking about delaying. I think we can feel confident, though, that it's at least staying in the right direction and hasn't gone much higher, which I think still indicates there's a lot of interest out there from consumers. And we also asked folks, well, why are you delaying? And you can see that the number of folks that are saying they're going to delay purchases has been, pretty steadily declining from where we were in the early part of the pandemic. We're now down to 22% saying that they're going to delay a purchase or a lease. But really, I think what's interesting is the reasons why they are going to delay, the top two. And of course, there's concerns about the cost and their own financial situation. But I think what's really interesting is the second one there is they're not driving as many miles as they used to. They don't need a vehicle. And I think that's one of the things that we're going to have to wrestle with in the industry. We're going to lose some people. The country's going to be different. Some businesses have figured out, hey, we don't need the downtown office. We can manage our business with everybody working from home. We don't know how big of an impact it's going to be just yet. Everyone's got to kind of get back to work and offices reopen to see what's going to be happening here over the course of the summer. But I think we are going to see a significant portion of folks that are going to say they don't need a vehicle as much as they did before, and so we may see a little bit of a pullback on the overall need for transportation. It's just something to keep an eye on. I think it's too soon to say that we've had a shift, that people are different now, but some of the early indications are that it may in fact be the case. And the last one I just wanted to talk about was fixed ops and people delaying services. We saw early on in the pandemic that about 25% of consumers were saying they were going to hold off on doing repair. Much of that, in terms of cost savings, they didn't want to spend the money. So folks are looking to be a little bit more careful with their spending. But we saw in the most data point we had from last week, it's actually fallen to just 15%. So it does appear that folks are getting much more comfortable with going out there and getting their vehicle serviced. And I do think in a lot of places where the virus was quite rampant, a lot of car dealers actually stepped up and figured out a way to provide services to customers without having to interact with them physically. And I know that was a big plus for a lot of consumers that were concerned with there. Why are they delaying? Well, it was really oil changes was really the big one, and certainly tire rotations. But again, directly correlated to the fact they're not using their vehicles as much, so they could delay many of these services. But as we're starting to drive again, we would expect that those services would start to be used again. All right, so let's get into the new and the used vehicle market and some of the details. And let's start by talking about the new vehicle market. Oh, I guess one of the numbers didn't pop in here, but our forecast for 2021 is we're expecting the market to rise to 15.7 million, and that's up from the 14.5 million that we finished last year. So about a 9% increase. I will say we're a little bit on the conservative side at Cox. I've seen other forecasts out there which are more in the low 16s to up to the upper 16 million for next year. But we think the guidance should stay a little bit on the conservative side. We're particularly worried that inventory limitations may hold back the market, as well as fleet activity, which isn't much of a concern for all of you, but for the manufacturers themselves, that fleet activity may remain a little bit more suppressed than initially thought this year. And so that would suppress sales as well. I just highlight here in the red circle, where we were a year ago when we were trying to do forecasts, when all of this was hitting the fan, I can tell you there was estimates all over the place as to where 2021 was going to finish, anywhere from 9 million up to 13 million. It was a dartboard method of forecasting because we really didn't know what the outlook looked like. We've never been in a situation like this. But when the dust all settled, most folks came in around the 14 to 15 million range. And that's where we came in for the year. And I think most people will look back and say that the vehicle market really was quite resilient, given all the turmoil that we had to deal with. Just to kind of walk you through some of the more detailed numbers, the overall market is much larger, right? We talk about new and used, but in terms of the number of vehicles sold, we sold 51.6 million new and used vehicles last year. 14.5 million were new, and 37.1 million were used. And our expectation is that we're going to see growth in both the new and the used market this year. And in particular, I've highlighted in green there, we see that in the new side that retail lease is actually going to be a big opportunity this year. And I'm going to talk more about that in a moment. But the retail side of the industry actually held up fairly well in 2020. It was only down about 9%. The fleet side of the industry was down almost 38%. We're expecting growth this year in retail, but it didn't fall that far, so it doesn't have that much more gain to get back just looking at retail. We think within retail, it's that retail lease, which is it was about 27% of the market last year, we see that having quite a growth this year of about 15%. And there's a tremendous amount of off-lease vehicles coming back, which could be a big opportunity for car dealers. I'll talk about that in just a moment. The other one I think that's interesting here, just to point out to you, is what we estimate to be franchise dealer sales within the used car market. And we see that there's going to be big growth for the franchise dealers this year in the used car market, about 7%. And what's also interesting, I've highlighted this in red at the bottom, the role of the used car market within the franchise dealer is going to continue to grow. We estimated that in 2019, about 42.8% of franchise dealer sales were from the used market. And we expect that in 2021, it's going to be a full percentage point higher coming from the used market. So the role of used is going to be important this year for car dealers as well as the manufacturers because they're going to have all these off-lease vehicles. And so managing those well is going to be important. And I'll explain to you in just a second why. So let's talk for a moment about some of the vehicle trends that we're seeing out there. And I think one of the most important ones is high vehicle prices. And I think I've shared this slide with you before, but boy, I don't think you can hit this point too hard, because really vehicle prices have been rising quite dramatically, and they really accelerated in 2020. This is a chart that's looking at the marketplace going back to 2012 and what percentage of the market had different MSRPs when they sold. And the key takeaway here is that in 2012, 54% of the vehicles that sold in the new vehicle market had an MSRP below $30,000. In 2020, only 24% of the nameplates sold had an MSRP of less than $30,000. It lost 4 percentage share just in 2020 alone. And we're seeing that higher price points, like the $50,000 to $60,000 price point, that's risen to almost 20% of the market. And the $60,000 plus price point has risen almost 10% of the market. So the industry is shifting to a much higher priced product and is essentially abandoning the lower than $30,000 price points. They're ceding that ground to the used vehicle market. So that's one of the interesting trends that we've seen happen here. And one of the most important trend has been this rising average price. And this is, I'm showing on the left here, the average listing price of new vehicles. And we can see that it just exploded as we get past the pandemic and topped out at $41,000 before retreating a little bit. Now, a lot of the drive behind this was due to the fact that the product mix at dealerships was really changing when the factories shut down over the course of the summer. We know that the factories had shut down, new inventories weren't being delivered, the dealers had to sell from existing inventories on lots. And so when the vehicles that came in to replace those starting in the summer, they were the new vehicles, they were crossover vehicles, they had more technology. And so all of that combined left us with a really quickly rising average listing price. And you can see on the right here, this is the year-over-year change over the last year. And you can see that it's actually trending up, that we're seeing prices actually rising at an accelerating rate. Now, I don't think this is sustainable indefinitely, but it does suggest that the demand for vehicles with all the bells and whistles, higher priced vehicles, is probably going to be in big demand this spring. And in particular, because higher income folks have survived this whole crisis fairly well, they may be in a buying mood this spring and are going to have the financial resources to really to follow through and get the product they really want. And we're also seeing these rising vehicle prices in the used market, and they're actually rising even quicker. On the left, I'm showing over the last 12 months, the average list price in the used vehicle market. It used to be sort of in the $18,000 to $19,000 range for quite some time, but we saw over the course of the summer that the average list price really exploded, and it too has backed off a little bit, but we're still seeing average price growth of 10% on a year-over-year basis. Again, this might not be sustainable at this level, but it is having significant ramifications for the market in many ways. Certainly, it's adding costs to consumers to be able to afford these vehicles, adding costs to dealers to be able to get inventory for them, but it's also having ramifications for vehicle values that are already sold. And that's one of the interesting things that we're starting to see in auction prices. This is showing the Manheim market report. It's basically tracking the value of a typical 3-year-old vehicle at auction. And what normally happens is sort of that orange line you see there, that a vehicle starts the year at sort of 100% of its value, and then through the course of the year, because of its aging and depreciation, you end the year at about 90% of its value. But what we can see is that over the last few years, this line has been shifting up slowly. And then we saw in 2020 that blue line that during the crisis, vehicle values fell dramatically. And then once we reopened for business last April, you can see this blue line really exploded. And it's now essentially at a different level. That vehicle values are now much stronger than what they were before. And they're actually rising much more quickly now than when they normally do. We usually see a spring bounce. As I was telling you before, tax season is a very popular time in the used vehicle market. So we see spring values start to increase then because there's a lot of demand. Well, you can see that green line. That's what we're seeing in 2020. It's already starting to make a climb even earlier than we did in previous years. So it does suggest that we're in for a very, very hot spring. And all of this is resulting in the fact that retention values have also made a significant shift higher. Now, the reason why this is particularly important is that all those leased vehicles out there that were leased a couple of years ago were thought to have, 58, 59% of their value when they came back to auction after 3 years. But what we're seeing now is that retention value has shifted up. They're going to have 5, 6, 7, maybe 10 points higher retention value than what we thought they were going to have 3 years ago when we wrote the lease. And so there's going to be a lot of vehicles that are going to be coming back from off lease in the money. And if we're talking a $35,000 vehicle and 5 percentage points of retention value, you're talking a couple, $2,000-$3,000 of equity that may be in that vehicle that somebody is going to be smart and take advantage of. And this year in particular, it's going to be a very important issue because we've got 4 million lease maturities coming back in 2021. It's down a little bit from what we had in 2020, about 100,000. We're a little bit past post-peak. Sometime in sort of mid 2019 is when we hit the peak of maturities, because that was about 3 years after we hit the peak sales that we had in 2016 in the new vehicle market. So it's starting to come down a little bit, and it'll fall even further in the next couple of years. But for this year, it's down just slightly, and we've got 4 million of these things. And they're going to be coming back, like I said, with their retention values much higher than what we initially thought. So I think that there's going to be quite a few lease pull-ahead programs from manufacturers. We may see some savvy consumers out there that realize that they have the option to buy their lease vehicle, that they may somehow try to figure out a way to exercise that option and try to do some sort of an arbitrage with their vehicle. I mean, that's difficult because there are costs involved for a consumer to do that. But certainly that's something that some savvy consumers may try. And dealers themselves, they may really be trying to get consumers, bring your vehicle back to me. So it may be quite a competitive market out there for these folks that are actually leasing these vehicles, because they're going to be in high demand. And we look at who has lease maturities. Well, Honda and Toyota lead the pack. They each have about 400,000 that are expected back this year. Stellantis has about 11% of the overall total themselves if you add up all their different brands. But again, this is a lot of product that's going to be coming back that maybe is not going to be quite the competition it was before. When these vehicles were coming back, they were generally going to be at a really large discount to their brand new counterparts, so a very attractive offer. These vehicles coming back aren't going to be quite as discounted, and so they may not be as much competition for the new market, but it's certainly going to be a lot of money to be made from these vehicles. And when we look at just within the nameplates themselves, what the top 10 maturities are, these nameplates are pretty common every year because we sell the most of them just in general. So they do the most in lease volume as well. Not that there's any particular extra focus on lease for these vehicles. But I think what's important to point out here is I looked at what was the share of these top 10, how did it change from 2016 to 2021? And really the big jump here is that the pickup trucks, the crossover vehicles, they're going to be a much greater share of these big volume vehicles that are coming back this year. We're going to have fewer of the cars. So the very mix of vehicles that consumers are most interested in, those are going to be coming off lease, and again, going to have a significant amount of equity in these vehicles. So I just suggest that to you, to be aware of that and to plan accordingly. The other one that we're dealing with, of course, is tighter inventories. And this is an issue that has really just been getting worse in the last couple of weeks. There's been a lot of talk about this chip shortage. We've done a little analysis on the chip shortage, and I have to say at this point, it's hard to find any direct relationship between the chip shortage of certain vehicles and any impact on sales. One of the things that we did notice is that a lot of the vehicles that are being impacted by the chip shortage haven't been selling very well, and in fact have a lower price point. There was a number of cars in these vehicles, and so it wasn't like necessarily the hottest vehicles out there, so they'd be really detrimental to the vehicle market. In fact, for some manufacturers, it may be a bit of a blessing that they have to shut down the product line because they already have excess supply of some of these vehicles. Our expectation is that the total impact of this chip shortage is probably going to be in the neighborhood of a couple of 100,000 units of production that are going to be delayed as a result of the chip shortage. But we do expect that ground will be made up through the course of the year. So it's not like it's production that will be lost entirely. But that said, the industry is still trying to make up for the lost ground from last year. And we got behind about 3.3 million units of production last year, and we're still making that up. So that's part of the reason why we're seeing lean inventories out there. So the chip shortage is only adding to the problem, but it's certainly not changing the situation substantially, at least not just yet. So just looking at the status of the new and the used market in terms of what we're seeing for sales, we're looking at rolling 30-day sales here on the left, and you can see that both markets had a nice U-shaped recovery or V-shaped recovery from the downturn last year. And there's now starting to show a little bit of a different trajectory, but it's because there's a little bit of seasonality. So it looks like they may not be in unison, but when you look at the annual change of these two numbers, of the new and used market, you can see that they appear to be on a fairly similar trajectory. And right now, it looks like the new market is actually holding up fairly well on a year-over-year basis, but the used market continues to be down just a little bit. But in terms of where we were at, really substantial recoveries for both. And the issue, though, is whether supply is going to be an issue. And we have some concerns that low inventories may be one of these new normals, at least for 2021, that we're going to be wrestling with through the course of the year. On the left here, I'm showing available supply. This is total number of units that we see out there in new vehicle inventory. You can see that it fell dramatically when the factory shut down and dealers had to sell out of their existing inventory. Started to rebuild last fall, but it still remains well below last year levels. We're still running about 16, 17% below total supply of what we had last year. Looking at days of supply is a little bit of a better metric to gauge whether you have the right amount of inventory, because you're looking at existing inventory divided by how many vehicles you sold over the last 30 days, and it gives you an idea of how many days will my existing inventory last me into the future. And we can see that days of supply is also down from where we were last year, about 16, 17% as well. So it's still a relatively lean market in the new vehicle side. And I don't know that the manufacturers are in any hurry to do anything about it. As long as vehicle sales continue to hum along, the advantage to being a bit tighter on inventory can be substantial. Certainly for the dealers themselves, you guys get to save some money on having to spend money on acquiring a whole bunch of inventory. And of course, the manufacturers are allowed to be a little bit more disciplined on pricing. And in fact, we're seeing that already. And this is showing incentives as a percentage of average transaction price. And you can see that over the last few months here on the far right, it's fallen dramatically. And we're now in February, we're at a 6-year low in terms of the role of incentives relative to average transaction price. So these tighter inventories have allowed the industry to be a little bit more disciplined. And that may be something that might be tough for them to give up on. The key is whether sales can still hum along. As long as they're not disrupted, it does suggest that we may see the situation last for a while. Now, certainly there are some vehicles out there that are being impacted. And just looking at some of the different brands, you can see Land Rover, Toyota, GMC, they appear to be in a relatively tight supply situation. I know Tacoma in particular, as well as Tundra, Toyota products, are in a very, very tight supply situation. But it's not the same for everybody. At the other end of the spectrum, you can see Acura, Buick, they appear to have a whole bunch of excess supply right now. So, this is a situation to keep an eye on. But again, I do think that the industry may be playing with this idea that we change the way we do business operations, and Americans buy vehicles much differently than other parts of the world, where you put in an order for a vehicle and you wait 4, 5, 6 weeks for that vehicle to come. You don't necessarily go out on a Saturday and just purchase a vehicle. So whether consumers can be trained to be patient for vehicles, to not have a whole bunch of inventory that they can pick from, that's something we don't know yet about the American consumer, but that may be a direction that the industry would like to go. The other thing is just looking at some of the different segments and the different inventory levels. We do see that the tightest segments appear to be the ones that are really the hottest right now. Certainly luxury small crossovers, small pickup trucks, full-size pickup trucks. These appear to be in the tightest supply situation. At the other end of the spectrum, you can see quite a few cars. And really, car demand continues to remain fairly suppressed, and particularly subcompact car, as well as subcompact crossover and SUV, and of course the hybrids as well. This does seem a little counterintuitive. You would think that in the middle of a pandemic, in the middle of a recession, when everybody's concerned about spending and consumer confidence and all of these things, that the lowest priced products in the market should do fairly well. But what we're seeing from this is that consumers just aren't that interested in these lower priced products. The available inventory of them is too much. And my guess is that a lot of these natural buyers in the new market of these segments have opted for either more expensive products because they're now able to, as a result of some of the financial assistance that the government has provided, or they've shifted into the used market where there's a lot more to choose from for the amount of money they may be able to spend than they can find to spend from in the new market, where there's just not a lot of product below $20,000 or even $25,000. So, the situation out there does suggest that the higher priced products are going to continue to do well. Consumers are not looking to save money on their vehicles. They want to buy the bells and whistles. And I think that trend is something that's going to continue into 2021. So on the whole, our expectation is we're in for a big year, but there are going to be some headwinds out there. And I think that high vehicle prices, managing that off lease is going to be a very substantial opportunity as to who can do it successfully. And of course, managing inventory and making sure that you stay on top of inventory. It's going to be critical for everybody this year because it is going to be a tight situation. So those are my comments. If anybody had any questions, I'd be happy to field those, or you can send them to me and I'd be happy to respond to you offline.
Charlie, we got one in that says, where do you see EVs headed?
Well, I think there's no doubt we're gonna start to hear more and more about EVs. They certainly get a lot more press than they do in sales. So I think we do have to keep that in mind. We're still talking about 1-2% of the market, so it's still pretty small potatoes right now. But there's no doubt that we're going to start to see much more EV activity over the next year. There's a lot of new product that's coming, new manufacturers into the marketplace. Rivian is supposed to have a new electric truck hit the market later this year. We're going to have the electric Hummer, I think, is supposed to hit this year. And of course, you've got the new Mach-E from Ford, which is coming. So there's going to be some new product, and some of it very, very high profile. Tesla has dominated the electric vehicle market. There's no question about it. But I think we're going to finally start to see in 2021 some Tesla competitors. And that's something they haven't really had before. Can Tesla fight off these competitors? That's something we just don't know yet. But I think it's going to be a real challenge for them, as there's going to be more and more options to choose from, more and more products out there with different capabilities. So it might be a rough year for Tesla. It's something to keep an eye on. But there's no doubt that electric vehicles are coming, and they're going to continue to come over the next couple of years.
We had one more come in, Charlie. It says, what was your next to last 2021 total light vehicle forecast before 15.7 million? Has that changed?
We started at about, originally we had thought next year was going to be about 15.2 million. So we did make an adjustment at the end of the year to increase our expectations for next year. And I wouldn't be surprised that we generally kind of revisit around April and August of each year to kind of gauge where we're at. We may need to make an adjustment. But right now, thus far, we've had the first 2 months of this year, and we had the first in January, we did a very, very healthy 16.6 million SAR. But then in February, we fell to a 15.7 million SAR. It fell dramatically. Part of that may be due to the weather in Texas, as well as fleet being a little bit weaker than folks had expected. But there's little to suggest right now just yet that we have an overheating vehicle market, that it's really going to start to do 16, 17 plus million. We just don't see that yet. Our expectation is it's going to be a topsy-turvy first half of this year, but we should start to see consistent growth in the second half of the year on vehicle sales.
That's great. Thank you so much for your time today, Charlie. This information was so helpful and much needed in this ever-changing environment. Again, to those on the line, you should be receiving a recording of the webinar by the end of next week. Join us back here Tuesday, March 16th, in a couple days at 2 p.m. Eastern, as Aaron Kerrigan of Kerrigan Advisors gives us an outlook on 2021's buy-sell market and franchise valuations. Be on the lookout for promotions on how to register. For more information about AIADA, visit aiada.org. Thanks for joining us, everyone, and have a great day.